Well, stocks taking a breather today amid a flurry of political headlines, earnings, and a cooler than expected inflation report. Financials, as we've been saying, under a lot of pressure, including Visa and MasterCard, down more than 4%, with the president's proposed credit card cap and other suggestions about getting around some of those networks weighing on that trade. Joining us now to share her thoughts on all of this is Barbara Doran, BD8 Capital Partners CEO. Barb, it's great to see you. Talk about your game plan heading into the year and what we've seen so far that's either confirmed it or caused you to rethink it.
Well, it's interesting. I think the consensus is pretty bullish right now, and also about the trade that's broadening out. And certainly we saw that in the last quarter with small caps, outperforming value, financials, some healthcare. And I think that's for the game plan coming in. For me, it's keeping the core Mag 7, although there's very individual stock stories at this moment because the earnings growth is real and sustainable, but whether they'll have the outsized returns, in the past, but I think they're still going to have good returns. But at the same time, you are looking for a lot of individual stock picking within sectors. I think, for instance, staples you stay away from. I'm not a believer in the small cap trade, even though the Russell 2000 has been a big performer, because I just think there's too many companies there that aren't profitable. They don't have the resources for AI. They don't have the flexibility in terms of avoiding tariffs and changing supply chains. So it's really trying to look at those different sectors, and within that, picking the best ones. And right now, for instance, you are getting opportunities like JP Morgan today. Why is JP Morgan down so much? I think it's because they're incorporating best case. Investment banking fees were down a bit. They had this reserve. But I think you're going to have these opportunities within sectors that should continue to perform well, given the economic outlook for GDP growth of anywhere from 2% to 2.75% this year.
When you talk about JP Morgan being an opportunity down 4%, I wonder also, though, if you have to read through to say, what does it tell us that a pretty good quarter gets a sell response from the street? Are people too crowded into the big banks? Is JP Morgan too expensive relative to the other ones? And how are you going to read through to the rest of the group as it reports?
Yeah, well, Mike, I think there is a bigger story here in that regard, and that's because the valuations in general, you look at the S&P 500, we're coming into this year at high valuation, 22 times. To me, that means volatility. Fundamentals, I'm a believer in the strong earnings growth story that we could see 15% this year. Fourth quarter should be good. We've had 4 quarters in a row of double-digit earnings growth, 10 quarters in a row of increasing year over year. But what it means when the valuations are this high, and certainly JP Morgan was way above its historic value mean. And so it's just waiting for some excuse to take profit. So I think, you could see a little bit more sell through tomorrow in a name like this, and you'll see this throughout the year. And certainly, I think the Mag 7 are a perfect example of the last few years. They run up, they more than discount what's going to happen. They sell off, but yet the story is still good, so you get back in at some point.
You mentioned, within the Mag 7, obviously, maybe you have to be discerning to some degree. It seems as if, the stampede has been into Alphabet as a way to kind of hide from some of the OpenAI risks and then just play this incumbent play on consumer AI. At the same time, the AI trade's going to Asia. I mean, those stocks are amazingly excitable, whether it's the chips or some of the Chinese internet companies. So is that informing how you would proceed from here? You're going to look for the laggards or the stuff that's working right now?
Well, I think you are seeing that a lot of people are looking for laggards in any industry, and particularly abroad. As we know, last year, emerging markets, developed markets abroad outperformed the U.S. market. And I think that is likely to continue this year. And certainly people are looking at China, which, as we know, has been a very volatile situation in terms of being uninvestable, now being investable, because that is where a lot of the action is. So I think people, will invest there and looking for cheaper companies with the same growth profiles. But for me, I will stick with the U.S. companies because I still see a lot of political risk dealing with, any company in China.